Standard & Poor's is saying we're facing an export-driven slowdown due to slowdowns in the EU and the US. Is it fair to say now that Treasury's growth forecasts in the budget are perhaps a bit too optimistic?
Not in the slightest. I think we live in a global environment. What happens around the world obviously has an impact on New Zealand. We're seeing that today with the stock market 2.5% lower and the exchange rate a little bit lower. But I mean, overall, Treasury's growth forecast was somewhere in the middle of the pack. There's a number of factors that will help New Zealand out when it comes to growth, not least them being the Christchurch rebuild and obviously a situation with the Rugby World Cup in the short-term basis. I mean, if the world slows down as a result of the credit downgrade, then obviously that is likely to have some impact on New Zealand. We're not immune from that. But one of the factors that does help is if you do see that slowdown, you're likely to see some pullback in commodity prices and potentially a lower exchange rate. So I'm reasonably confident we'll meet our forecasts.
You're basing your views on an export-led recovery. Isn't it a bit dangerous to say that outlook is still as rosy as it was before? And, the US and EU slowing down, and China and Australia won't be able to hold their rates of growth if the rest of the world around them is slowing down.
I think it's a slightly different situation in the US. I mean, non-farm payroll numbers weren't too bad on Friday. Overall, look, I think what you've got is just a situation where Standard & Poor's is telling the United States it needs to take its medicine. And we were of the same view back in 2010, 2011, when we put together our budgets, that we had to take a responsible view and keep an eye to what the rating agencies were saying. And if we didn't do that, we'd be downgraded. And I think that's the challenge, is how efficiently the US can work through an environment where it has less spending. But I think it's a little bit too early to make predictions of exactly what that means. You've still got a strong Asian market. So it'll have some impact, but I personally, I'm just less pessimistic than say I was back into 2008.
One of the arguments for New Zealand being such a good bet is that we've got low public sector debt. Yep. But Standard & Poor's and the other ratings agencies are increasingly lumping private sector debt.
Correct.
Is there more we can do or should be doing on getting New Zealand's private sector debt down, or are you comfortable with?
No, I think we take on board seriously the issues of Standard & Poor's view that our net external liabilities are high, and that includes both public and private sector debt. That's why we made the changes in budget 2010 and 2011. In particular, raising consumption taxes and dropping personal taxes, dropping the taxes on savings, trying to get rid of the anomalies in the system, taking $1 billion out of the property market effectively. All of those things were all attempts to lift national savings, as is the potential case that we're looking at, whether we have auto-enrolment for people that aren't in KiwiSaver but are currently in the workforce. They're all actions aimed at trying to lift national savings.
But given the current market turmoil and the fact that our banks still borrow about 35% of their funds offshore,
correct,
the hot money market, should there be more done to get them to try and focus on domestic funding rather than...
Yes, but I think if you look at how you can increase national savings, which is the basic argument, you ultimately have to go back and say, how do we do that? And that is, New Zealanders generally need to be wealthier. That gives them great opportunities to save, and they have to have opportunities to save. That's one of the arguments around mixed ownership model, is about extension of the assets available for New Zealanders to invest in.